Right, Yield Nerds, episode 111, and I am going to eat crow. I have been wrong all along, and two wonderful arguments have been made that pretty much say T-bill and chill is an absolute blunder right now. So I will be challenging myself using these two wonderful arguments in this episode. Thank you for your time. Well, we are at 269 something subscribers. Appreciate the support and my usual disclaimers and updates. If you are jumping onto episode 111 and you're not knowledgeable in fixed income investing, I would humbly suggest start where I started, episode 1, and that would be on the playlist. So feel free to listen to that. Most importantly, don't trust me, do your own homework. Well, I'm going to be using the analogy of the tomato farmer today, and I've used this analogy before, and I'll give you a couple of links to refresh yourself if you need to. And I'm going to take these two scenarios that make great arguments to challenge why bond funds are where you should park your money and not individual bonds. And I will then deliver my education and my message, and I will promise to be objective and neutral in looking at these two amazing arguments. The very first thing, speaking of the tomato farm, you may want to check out episode 6 and episode 9. Episode 6 is a short, barely 1 minute, and episode 9 walks you through the detail of how bond investing and fixed income investing is like tomato farming. I've posted links to that, since you should be able to look at that and take a quick read if you're new and you've forgotten the tomato farming analogy. Using that same analogy, buying individual bonds would be like buying a small number of tomatoes and growing them in your own home garden. And the bond market, if you were to invest in a bond fund, that would be like going to a tomato farm where they have these huge amounts of tomatoes. Thank you, Dolly, for growing tomatoes in front of the New York Stock Exchange. It looks amazing. I hope it comes true. Well, so am I a blunderer if I were to grow my own tomatoes? And should I instead go to the bond fund or the bond ETF? And that is what I'm going to be exploring. And I'm going to be looking at specific securities, specific funds. And I want to make it very clear to you, I am not a wealth management advisor. I don't do politics. I don't pitch products. This is not investment advice. So I don't have any sponsors either. So let's go to the very first argument, which is, you idiot, why are you doing individual bonds and individual treasuries? You should be doing bond funds. T-bill and chill? No, it's T-bill and lose. So here are the disadvantages that were pointed out to me. The first is I put $5,000 in a T-bill auction, and after the auction is done, I have 200 left or 300 left or whatever left, because I don't know exactly what I'm going to be spending. And the bigger my amount, the bigger the balance, and that balance sat there and it did not make any money, or it made really low amounts of interest in my brokerage. And so T-bill and chill is terrible. I should instead be buying a really nice ETF. And there are short-term ETFs. And to be clear, I'm not endorsing or shorting or otherwise dissing on any ETF. I'm merely responding to a challenge given by one of our listeners, Max. Thank you. So the ETF in question was SGOV. So let's look at SGOV. It's a wonderful ETF, $15+ billion in it, clearly very well adopted. And the managers, the fund managers, say they will invest at least 80% in 3-month T-bills. And when they do that, at least 90% of it will be in T-bills, even if they are not 3-month. And so it's very short term. And so then the question is, what do they pay? Hey, look at that, not bad at all, 5.16%. And to make it even more attractive, they give these dividends once a month, which is fantastic. And they have 18 billion under management. The net expense ratio is next to nothing, 0.07%. Maybe T-bill and chill is a terrible idea. Look at the fund itself. As a matter of fact, it has risen from 100 to 100.3. That's not a really big improvement, but still it's proof that this fund not only maintains its capital value, but also pays really good dividends. And so it was a moment of truth for me. I have to sit there and say, should I quit, growing my tomatoes in my little, home? And should I go to the market and buy these enormous amounts of tomatoes. And so I started doing some analysis. And so I thought, gee, what do I get when I go to the market direct and buy 3-month bills? Because this fund pays 5.16%. That is not shabby at all. Wait a second. I get 5.38 if I go direct. So, what's 0.2% between friends? That's only 5% that I lose there. And then I started looking at the price of the bond itself and realized there's this big dragon tree that goes up, it goes down, it goes up, it goes down. And I had to stop there and say, well, why is that happening? And how are dividends paid? And the devil is in the detail. So the X date is always the first of the month, and then December they have two dividends, and that's just the way they manage their fund. So the X date is always at the beginning of the month, and the payable date is the 7th of the month, which also tells me that if I sold something on the 28th, for example, I lose the entire month's dividend. And then I sit there and say, wait a second, can I game this? Can I buy this on the 28th of the month, hold it just for 1 week, grab the dividend and say, gotcha, sucker? And the fund manager is too smart for people like me. They intentionally sell more shares to drop the price of the fund by the exact amount of the dividend. So you can game that smart. And in December, they drop the price of the fund twice to make sure people like me don't scam the dividends. Good for you, SGOV. Bottom line is, you have to own it for the entire month to get the dividend. Otherwise, you will lose. Another thing where I feel like my freedom is being limited. One more detail. Remember how they said 90% of the time we'll do this, 80% of the time we'll do that? That also means not all of your income is state tax exempt. In the T-bill, as you may remember, all of your income is state tax exempt. So not only do I lose 0.2% of yield, which is 5% of what you get, not only do you lose the freedom of selling whenever you want to, you also lose some of the state tax credits that you get. And one more thing on that pesky fee, remember how it was minuscule 0.07%? Turns out it is a hot sale. And it is a hot sale temporarily. And when that discount runs out, because the difference between expense ratio and net expense ratio is discounts, and they are running a special promotion this week only. You get a vacuum cleaner and a 50% discount on their expense ratio. And so when that runs out, your fees actually double. So all in all, this leads to, in my humble opinion, a situation where you have less freedom, more fees. And one more thing, when interest rates drop, notice right now the volume is huge because interest rates are very high. At the same time, when interest rates drop, nobody wants to use this. And so there is also the possibility that if you buy right now when the prices are above 100.0, as interest rates drop, you will lose both on the front end and the back end. So my decision, and I created this on Dolly, this guy is pouring hot tea on dollar bills and it's obviously very chill. So hey, you know what? I'm going to be T-billing and chilling and not buying SGOV. You do you. This is just my decision. But remember, this is only the first argument. Then I go to the second argument. This one is made by an expert, so I am bracing for my decision. Wall Street Journal. Do you want a tax shelter? Buy a bond fund. Right now, you can increase your exposure to bonds while reducing your exposure to taxes. Grab this deal. And the article goes through a lot of detail as to why, instead of owning individual bonds, you should go to that market. Look at that nice fella. And he's collecting a lot of dollar bills, selling tomatoes in the farm style. And the premise is the following. Bond funds have a lot of bonds. Many of those bonds were bought when interest rates were low, and they are underwater. And if you bought that bond fund right now, and I am lining up, a whole bunch of investors are lining up. If you bought them right now when the bonds are underwater, that 92 cents is going to become $1. And guess what? Your income of that piddly 2.5% is ordinary income. But hey, there is going to be long-term capital gains on that 8 cents. Look at what you did, smarty pants. You took some of your income and converted it into a lower tax rate. Buy bond funds. Do not buy the individual bond. look at how smart this strategy is. And it shook me. And so I had to go do a lot of digging. And so I started looking at his numbers, and he makes a very, very good argument. He says last year it returned 5.7%, and I'm going to say about 2.4 of that is from price appreciation, and the price appreciation for 100,000 is about $405, and your return could go from 3.6 to 4%. And I started doing some math, and my guess is this author is assuming a marginal tax of 42%, effective tax of 25%. That's a lot of taxes. And so the author says, if you invest 100,000 at a 5.7% return, you would have gotten 5,700. And they say, 2,400 is capital gains tax. And so instead of paying, the 42% on the 2,400, you're going to pay 25%, which is your effective tax on the 2,400. And that is how the author is getting $400 savings on 100,000. I said, wow, that's a pretty strong argument. You got me. Let me do some research. And so I went and looked at one of my own bonds that I had bought at $94 and sold at $96. I have never, ever sold a bond before maturity, and I experimented to learn. Sometimes you have to question your sacred beliefs. And here is my income, and this income flowed through as ordinary income, as it should, because bond income is ordinary income. What I was looking for is, did the Wall Street Journal article pan out for me? Because in this scenario, the $2 right there is long-term capital gains because I bought this bond in 2022 and sold it in 2024. And so I was very excited. I went to my statement, Schwab statement, and said, show me that long-term capital gains, and I'm going to dump all my money into these bond funds. Yes! Wait, zero? Why is that zero? No long-term gains, no short-term gains. I was very irritated. I called customer support and said, you made a mistake. Your reporting system has a mistake. And they said, son, please sit down. Let me explain. And they said, you bought your bond at 94. If you held it all the way to par, we would have put the accrued interest, and this is the appreciation from 94 to 100. Every day we'd be adding a nickel or whatever the fraction is. And if you held it to maturity, your capital gains would be zero. As a matter of fact, you could sell it any time along the way. As long as you sell it at fair market value, your capital gains will always be zero. You would get nothing by selling it in between, because every year, or frankly every day, you've been accruing the difference between what you bought and the par value and moving it down to ordinary income. Uncle Sam is pretty smart. Uncle Sam says, hey, my friend, I'm going to keep docking you a little bit every day on ordinary income, so that game is not available to play. The only time you have capital gains is if you find an inefficient market, and in that inefficient market, you are able to sell it for more than what it is worth. And you have to say, gee, how do I find that inefficient market? I'll leave it up to you how to find the inefficient market. It is not available to me, at least as far as I looked. And so the government says the only time you get capital gains is on that little smidgen above the value, and most of it is going to end up being ordinary income anyway. And then I sat there and said, what if I am the fool if I sold it below the market value? And the government says, sure, I'll give you a capital loss, but only for the difference between the fair market value and the capital loss. And here is something that happens when you try and sell on any online brokerage today. You know the price, you know the bid-ask spread, you know what amount the bonds are available. By law, they can't quote you a number that is not the true value. And so if for whatever reason your bond is the world's greatest bond and everybody wants to go and they are willing to pay above fair market value, that would truly mean that somehow they want to own that bond and make less money than parking their money on the federal funds rate. Now, I don't know how that could happen, but presumably it could. And so scenario number one for the Wall Street Journal article to come true is that someone would buy the ETF share at a price higher than the market price, And that same person is going to scoff at your individual bond. I'm sorry for putting the snake oil barrel here. I do not buy it. But if you do, then by all means, you should buy ETFs and bond funds instead of owning individual bonds. Scenario two, and the snake oil barrel remains. If you believe that there is a bigger basket of bonds, maybe people wouldn't be idiots on one bond here or one bond there, but you got to find some idiot, some inefficient person who says, even though the bid amount is X, I want to bid higher than the bid amount. If you try and buy an equity and the price shown is 100, and you go there and say, I want to pay 102, try it. You wouldn't even still pay 102 because law requires that they should accept the lowest available sell. And so even that scenario wouldn't even happen. And so I'm sorry, the snake oil is still there. But if you believe that somehow there is an inefficient market, then you can buy the ETF. Scenario three can happen. Let me explain what scenario three is. If you say the ETF administrator buys billions of dollars of bonds, they could have gotten it at a lower price than me. Sure, that can happen. And so even if both of you sell at the same price, they'd have gotten a better deal. Yes. However, even they will be selling at their fair market value, not yours. So at the end of the day, there are two problems with this statement. And the very first is the magical word. He figures that approximately. So the author of the article doesn't know it. He's just making a nice wild guess. So here is my guess. If tomatoes are the size of soccer fields, you can sell 63 million of them for $1,000 each in 6 minutes. You process that. I will keep moving. My message is very simple when I read this article. When I buy a bond at a discount, I know what I'm paying. I know what the coupon is. I know what the par value is. I know the yield to maturity. Either I'm happy with that or I'm not. And so I'm just going to hold it to maturity instead of selling it and hoping that there is an inefficient market. So my message and my education to myself, the moral of the story is simple. If you tell me that 90% of the time you'll speak the truth and 80% of the details will be shared, I suppose, if I really still wanted to talk to you, then I'm the kind of buyer who would buy a bond fund over individual bonds. I want my par value back. I would rather buy an individual bond and take the default risk than buy an ETF and have no idea when the bond is going to mature. And lastly, your ETF's income is under the bond manager's control or the ETF manager's control, not my control. I don't like that. And when I hear advice that benefits the advisor 100% of the time and me most of the time, I don't buy it. And at the end of the day, I'm not a fidgety trader. Yes, for 2% of my portfolio, I throw them at equities and hope for the best. But my style is to make a cup made of dollar bills and pour tea into it on a very chill day, meaning I still T-bill and chill. Thank you for your time and have a wonderful day. Thank you for listening to Yield Nerd, a do-it-yourself show for yield accumulation and management.